Welcome to the Zandbergen Report, where wealth strategies and investment wisdom collide, featuring your distinguished host and certified financial planner, Bart Zandbergen.
Welcome to the Zandbergen Report, a showcase for wealth strategies and investment wisdom that's essential for our evolving world. I'm your host, Bart Zandbergen, and as usual, we have Paul in studio today. How are you, Paul?
Oh, I'm a little under the weather here. You've so overwhelmed me with the desire for jets and planes and stuff here. I think I'm just in a ordinary man funk here, you know.
Well, we're going to see if we can get you out of that today, because we're going to talk about something very serious today, and that's about money. And I have a very special guest today, Kevin Williams with BLACKROCK, one of the biggest money managers in the entire world. Kevin and I work very closely together and with many of my clients. So, Kevin, welcome to the show today.
Thanks, Bart. Thanks for having me on.
Yeah, of course. So we could go in so many different directions with BLACKROCK, and but what we're going to focus on today is really just the concept of fixed income, and we'll break down fixed income from the different components of what fixed income is. And then we'll talk about BLACKROCK's perspective on that and kind of some of the things that you're doing to help me and my clients.
Sounds great.
So, Ken, let's start with let's talk about your story. So I know you're a CFA, and for those who don't know, that's called a Chartered Financial Analyst. And Kevin, what is it? What is a CFA?
It's a Chartered Financial Analyst.
Chartered Analyst is what I meant to say. But, no, we made a joke earlier. The most prestigious.
Oh, yes, I was joking. It's the most distinguished designation in the industry.
I'm a CFP, so this is the common rivalry between CFPs and CFAs.
I think you went the smarter route.
So a little bit about your background, Kevin, how you got to where you are today.
Yeah, certainly. I grew up in Northern California and went to St. Mary's College in the Bay Area there, right in Moraga, most famously known for our basketball team full of Australians, more of those than anything, but had the unfortunate timing of graduating school in December of 2008 in finance.
Perfect.
Yeah, so it wasn't exactly the most robust job market at that point, so decided to continue on and go to graduate school. And once I finished that, I started my career at Wells Fargo and then moved over to Vanguard, which is a large competitor of ours that I'm sure many of your listeners know of.
Sure.
And then I actually moved over to a real estate firm and started working in private placement real estate opportunities, and then really just kind of wanted to expand the opportunity set that I have and be able to really offer everything across the spectrum, whether it's alternatives all the way to low-cost ETFs, and really be an advocate for you in your practice. So that's when I got the opportunity to move over to BLACKROCK in 2015 and been there ever since.
Yeah, and I'm glad that you are. We've done some great work together, I think, for some of our mutual clients, and you play a great role in that for me.
Great. Appreciate the partnership.
Of course. All right, so let's kind of break it down a little bit for our audience. I think most people know what a stock or is equity, but let's just kind of start there. And I think
Certainly.
At the end of the day, there's two basic types of asset classes when we're talking about the investment world. Of course, you have equities, which could be our stocks, and that's considered ownership in a company, as we know. Now, what some people don't know is that fixed income typically made up of bonds, and we know that as to be loanership, that you're actually loaning money, and it can be either to a government entity or a corporate private entity. And then within the government, we have something called municipal bonds, and we're going to spend a great deal of time talking about that. So let's start about the role that I think that fixed income or bonds play in a client's portfolio. From where I sit, especially in a market as we are today, we've had a tremendous equity market since 2008, since you graduated from college.
Certainly.
Notwithstanding the first 3 months of 2009, before the market bottomed out. But there's certainly enough there to cause caution for portfolio design going forward. And I think that's where we find ourselves today. We had a very robust stock market return. Part of which was seen this caution was warranted by what we saw for Q4 of 2018. So within that, I think a well-diversified portfolio is going to have a component of equity, which is going to be kind of the risk on and have more growth potential. We will use the fixed income or bonds for more of the asset protection or capital preservation, as well as income. And then, as you know, since 2008, the alternative area has grown, and that's probably, we can have a conversation maybe next time you're in and maybe spend a lot more time on that. Maybe we'll cover a few minutes of that today.
Yeah, certainly.
Because you guys actually have a couple offerings there that I really, really like. So we'll save equity conversation for another day. Let's talk about fixed income. Kevin, I'm going to let you chat a little bit from your perspective, kind of break down the different types of bonds, and then we'll kind of ultimately hone in on your municipal bonds.
Yeah, certainly. And I think you did a really good job of summarizing the role of fixed income. Really, there's three components. It's equity diversification, it's capital preservation, and generating income. A very unique dynamic, though, since we came out of the financial crisis in 2008, is really you weren't able to achieve all three. You really kind of had to pick two. So it was either equity diversification or capital preservation, and then it was hard to really get all three pillars. The nice thing that we've seen over the last couple of years anyways, and particularly with municipal bonds, is you are starting to be able to achieve at least some level of all three of those pillars. But I think the major role of municipal fixed income, and particularly the way that we use it with your clients, is really capital preservation and generating really attractive, tax-efficient income. But taking a step back and looking at the fixed income market and the types of securities, you mentioned that they are loans. So you can loan to a corporation, you can loan to our federal government, or you can loan to the state governments. Now, what you have to realize when you loan to a corporation, all of the income or the interest that you pay the same way as if you were borrowing money for a car or for a home, it's just the reverse of that. You're giving them your principal for them to make improvements to the company or capital expenditures, and you're receiving that loan payment. If you loan to a corporation, all of it is taxed at your
income tax rate.
Yes, your income tax rate. Mm-hmm. Now, if you loan to just the federal government in what's called a treasury bill or a treasury bond, it's exempt from federal income tax, but you still have to pay the state tax on the income coming in. Now, the great thing about municipal bonds is if you loan to a municipality, a particular state of California, all of the income that you bring in is tax exempt. So you do not need to pay taxes at the federal level or the state level for that income coming in. And that is really powerful, especially in high tax states like California and New York, and you kind of name it. But particularly in those two states, that becomes a very powerful component of the portfolio.
Yeah, and from where I stand, we call those the SALT states these days, right, after the new tax law change. State and local tax.
Correct.
Paul always likes us to define what the acronyms are for our listener. So, in an environment, and we're going to get a little more technical here, in an environment where bonds could not perform as well, it's in a rising interest rate environment. Mm-hmm. And as you and I both know, for about the last 35 or plus years, interest rates have been falling, so value of bonds, because of the inverse relationship. So just be clear, inverse relationship, falling interest rates, rising bond values, mm-hmm. and then the opposite. So now we're in a rising interest rate. Arguably, maybe we're done. We'll see.
Yeah.
But what I found fascinating and talking to your team was super interesting as well, is in a year where we thought, perhaps our bond portfolio, would definitely have positive income, but would it outperform the negative net asset value of the bonds was questionable, and it still outperformed. And I think I'll let you answer that, but my takeaway was, hey, one, we're in California, SALT state. The desire for those bonds for the people who live here are high, so then it becomes really a supply and demand economics issue. Would you agree with that or want to add to that?
Yeah, certainly. I think when you have limited supply and you have excess demand, there's going to be an artificial floor to where those bonds are going to be able to trade. And I think another very important, and this is kind of going into the weeds, angle of the municipal market is it's really dominated by large institutions. So when you come to a firm like ours or another large institutional manager, we're able to access bonds on the primary market, meaning interacting with the actual company that's issuing them, rather than having to interact on the secondary market where everybody is buying and selling. So what that allows us to do is have a little bit better control of the price that we're buying at, the terms that we're buying at, and also not have to deal with the competition on the secondary market. So there's definitely a benefit to buying and scale there. And it does just allow us to get better pricing on bonds and execution. And then what we're able to do is pass that down to your clients in the form of savings on trading and things like that. And you have to think, in a world where you're in a lower return environment, when you're looking at 3 and 4%, basis points matter, where you start to figure out, all right, how much are we paying for these products? How much are we paying in trading? Anything that we can save and pass on to your client is meaningful when it comes to total return.
Yeah. And Kevin's being a little bit modest as far as the size being one of the bigger players. I mean, you are the biggest money manager in the world, if I'm not mistaken.
Yep, we are.
And what dollar amount is that?
Depends on what day of the market we're in, but we're floating right around $6 trillion. $6
trillion. That's a couple of zeros, Paul.
Definitely not rounding error, that's for sure.
And you I think you described it more eloquent than I usually do with my clients, in that when you come to the table, which is good for my clients, and to say, hey, we want to unload this bond today, and you're going to take it, and so people take it. And then vice versa, when you come to the table and say, hey, this is what we want, my impression is you get what you want at the price you want, which again is good for our clients.
Yeah, and I think you can draw the similarity to any sort of buying and selling relationship. If you own a privately held company and one of your best clients come to you and say, hey, I need to get rid of this, can you help me out? Generally, you're going to make that concession or do what you can to make that client happy, because they turn around and they say, okay, well, now I'm going to buy my normal level of assets from you, and if they're your best client, you just want to keep that client happy. Same thing happens in the bond market there, so we can kind of use our size to execute where we need to on maybe some of the more undesirable bonds that we receive and want to trade out, and not get beat up as much for the price that we would if we were to just go into the general market and try to sell it if it's I don't want to say highly undesirable, but if it's just a bond that there's not a lot of demand for, obviously the price is going to be depressed.
Sure. So let's kind of move to a slightly different subject and talk about the difference in yield, some being taxable, non-taxable, and what you and I talk about is taxable equivalent yield.
Mm-hmm.
So as an example, let's say someone says, hey, I can get this bond that's yielding 5%. And we might say, hey, well, there's a municipal bond that's paying 3%. And this investor might say, I'm certainly going to take the bond that's 5%. Well, what we'd have to factor out is 5% is fully taxable. 3% in this example that I'm making up would be completely tax-free. What is better for the client?
Certainly, and I think you have to look at the tax equivalent yield, because it puts the municipal bonds yield on par with what it would be if it were an otherwise fully taxable bond. So a lot of times what you see is municipals yield lower because of that tax equivalent yield, but there's a financial ratio and a math equation to, depending on your client's tax bracket and a few other variables, that you can use to put it at its tax equivalent yield. So for example, what you would see is maybe an investment grade bond or something that you're loaning to a corporation yields 4.2%. And then you take a look at an otherwise similar municipal bond, maybe it's yielding 3%. But when you do the tax equivalent yield, oftentimes that bond can actually be yielding the same or even times more than the corporate bond. But you also have to realize you're loaning to a municipality or a government that often is going to have a higher credit quality than the average corporation. So you kind of get the best of both worlds there in some cases.
Right. And then before we go to break, so let me just further clarify. So let's assume you have a very high wage earner, and as a high wage earner in California, it's not hard to get to a 50% tax bracket. So in addition to his 50% he or she is paying on their income, Now they have, let's say, 4.2% coming in on this bond yield. To make it simple, cut it in half. So 4.2 becomes 2.1.
Yep.
Right? And if the municipal is paying anything over that, 2.5 or above, or 2.2 or above, you're better off with the municipal.
That's correct. And that's where you either adjust the yield up or you want to take the taxable rate for the taxable bond and bring it down. But it's just really to make an apples to comparison to what is the actual income you're going to be receiving.
Perfect. All right, Paul, let's go quick break.
With more than 25 years of experience, Bart's comprehensive perspective has earned acclaim from clients across the globe. Gain access to lessons learned throughout Bart's career by following @Bart Zandbergen on Instagram. To learn more about Bart Zandbergen as an advisor, mentor, and public speaker, and for more information on Optivest Wealth Management, please visit www.bartzandbergen.com.
When you use the Premier Rewards Gold Card from American Express, the rewards points can keep on multiplying. Buy 3 with triple points on airfare. Buy 2 with double points on gas and groceries. And a single point for pretty much every other dollar you spend on the card. Then, start choosing from over 1 million rewards to redeem all those points. Apply today and the annual fee for the first year is on us. Call 1-800-AXP-GOLD or visit axpgold.com. The annual fee for the card is $175. See terms, conditions, and restrictions at axpgold.com.
Imagine what it would feel like to lose everything. Your job, your home, your family, your dignity. This has happened to thousands of the men, women, veterans, and young adults we serve at Working Wardrobes. What do we do to help? We provide career development services, life skills workshops, job skills training. We provide the perfect interview outfit, and we get clients placed in jobs. Call Working Wardrobes, 714-210-2460. Donate, volunteer, invest, hire.
All right, we're back. Can I just ask you one everyman question here? Bonds, particularly municipal bonds, still good things, even though we've had so many municipalities file bankruptcy and all that. Are they still as sacrosanct as they once were?
Well, I think the municipal bond market is huge. The statistic goes there is over 70,000 unique individual issuers. So when you think about all of the different municipalities, it really comes down to your credit analysis of what you're buying and knowing what you own. I think at BLACKROCK, we pride ourselves on our credit analysis. We have 20 individuals that they spend every day of their working life going through and analyzing what bonds we want to own. And that's really going to be the differentiator when things, when we head into recession or we have a credit event, which ones are going to hold up and which ones are going to fall in value.
Yeah, I think one of the things that I appreciate most in our relationship with you and BLACKROCK is, among other things, is the level of research on the credit. Because at the end of the day, when you know what hits the fan, I think the credit is really what stands out. And so that's important.
Yeah, you want to make sure the income payments are going to keep coming.
That's right. That's right. All right, so let's talk for a minute. We mentioned it earlier, but the kind of the SALT states and what that really means, and again, what makes a municipal so valuable and something like that.
Yeah, I think this is a very topical issue that just happened in 2018, in particular in California, and there's a few others. But basically what it is the state and local tax deductions used to be unlimited, so you could use those deductions to effectively bring down your tax rate, particularly on income tax rate. Now those deductions are limited to $10,000. So what that leaves you with is, if you're a high income earner, you're going to be subject to the maximum taxable rate in states like California or New York. And it's really a high amount. So if you let's take California, for instance, the maximum federal income rate, 37%. Then you add on the now new maximum California income rate with the SALT deductions, 13.3%. And then Medicare tax on net investment income, 3.8. So you effectively could be paying 54.1% in taxes as a California high income earner. So think about giving away over 50% of the income that you earn just because of the new SALT deductions. That being said, investing in a California municipal bond, all of that income would be tax-free because it's federally tax-free and it's now California tax-free as well. I shouldn't say now, always has been.
Yeah, yeah. Great, and that's exactly why we still think they're important and why our biggest clients are still heavily invested in municipals. So here's something that you and I have kind of talked about before, and I've had a client actually ask me this. So we look at the current yields or returns or total return on municipal bonds, and we look at with the rising interest rate, CDs, you call it, depending on the maturity or the duration, 2.5%, maybe up to 3%. We've got some higher paying money markets that are in the 3%, some annuity products we talked about guaranteeing 3.5%. So the question was posed to me, and I'm going to let you answer because you guys answered it very eloquently before. So why would one invest in a municipal portfolio with arguably lower yields right now, knowing that we could get some higher yields in some of these other areas?
Certainly, and I think it's a three-part question. One, the income you're going to be receiving from a money market or a CD is going to be taxable, so you have to account for that. Secondly, you're not getting diversification from those because they're a steady value, whereas municipals have a negative correlation to equities. So not only are you getting that income, you're also getting diversification, so it's going to zig when the equity markets zag. But unique to now, which I think is very appealing, is we think interest rates have largely risen for the most part as much as they can, or I take that back, that they've risen to a level where we're not terribly concerned about the rising of interest rate having a large risk to the principal value, like you mentioned, that relation before. But what it allows us to do is really start buying some bonds a little bit further out on the curve where we're getting higher yields. We're getting things like 4 and 5% yields, which allows us to not only collect higher income, but it also gives us a buffer that if interest rates do rise, we have some income cushion. A few years ago, that wasn't necessarily the case. So we're in a really unique environment for municipal bonds right now, and I would say fixed income in general, but particular municipal bonds for that reason makes them very appealing.
Yeah, I think those are great response. And just to clarify, when you say further out on the yield for our listener, that means that the maturity or the duration of the bonds are longer. So just like if you were to buy a 5-year CD versus a 3-month, you'd get a higher return on a 5-year CD. It's the same with bonds.
Exactly right. You just have to think if you're loaning somebody money for longer, you're going to require more of a security cushion in the form of payments to take on that extra risk. If you loan money for 3 months, you're going to get that back pretty quickly, so you're probably not going to charge very much. You loan money for 30 years, you're going to require some compensation for making that risk and taking on that credit.
Exactly. And you mentioned the negative correlation, and what I find interesting, while just in general, this is more of a philosophical statement, that in the investment world, we're finding correlations are really tough. And to define what a correlation means is the movement of one asset compared to another, kind of simply put. So if one asset goes up 10%, if something is completely correlated, it's going to go up 10% as well. If it's completely negatively correlated, a 1-to-1, something goes up 10%, the other goes down 10%. Now, old school, when I first got in the business in the early 90s, so great, bonds and stocks completely negatively, not completely, but very negatively correlated. Do a portfolio of 80% stocks, 20% bonds, made 20% a year, life was good. And then we hit the year 2000. And it has not been the same since. We've had 2 recessions, one, arguably a depression or close to, finding that correlations are not quite what they used to be. But what I never like to use the word always or never use the word never, but what I see more frequently, even with the correlations being closer, that flight to quality, I think sometimes is kind of a catch-all, meaning stocks are going nuts, and like maybe Q4 of 2018, people some investors get a little freaked out and they want to run to quality. And where do they run? They run to bonds.
Certainly.
Oh.
And that dynamic in a portfolio is desirable. And a lot of people ask, well, why would we want everything to move opposite in the portfolio? Rather just when one thing goes up, everything goes up. But what you have to realize is then when one thing goes down, everything goes down. But by adding a mix of low correlated or negatively correlated products to a portfolio, you oftentimes get to the same end result, but you do it with less volatility along the way. So you're basically asking yourself, would you like to drive on a bumpy road to get to the same destination, or would you like to drive on a smooth highway to get to the same destination? It's kind of the same dynamic there. The great thing with municipal bonds is they do offer a very attractive negative correlation. And what you're looking at is, on average, when the S&P 500 is down, say 4.5%, municipal bonds are often up at least 0.5%, sometimes even 0.75%. So basically what it allows you to do in a portfolio is when your stocks are going down, and that's going to be the growth of your portfolio, it allows there to be somewhat of a floor, and we call that downside protection, of how far they're going to fall. And that flight to quality is really people moving out of the riskier stocks and moving into the safer bonds. And if you already own those safer bonds before people make that move, you're going to see the price appreciation. It comes back to that supply and demand conversation that we were having earlier.
And it goes, and we're running out of time, but it goes back to a more fundamental investment strategy, and that is not to go back and forth, but to have that allocation. Now, not everyone shares this, but this is my philosophy. You develop your allocation, and it might be, hey, I have 35% bonds, and that's just the way it's going to be. And so the balance of the portfolio will take care of the bumpy road, in my opinion. Certainly. And the other thing that helps, and we're out of time, and I'm going to bring you back because there's a whole other conversation on what we would now call alternative investments or alts. I know BlackRock has a few that we like to use, and I think that would be a great subject for a future show.
Certainly. I'd love to come back, and thanks for having me on today.
Sure, of course. And it's been a great pleasure having you on the show today, Kevin. And one of the things I have is the honor of asking my guests their final thought question. So if you could share with us and the audience your ultimate lesson learned in your career as a investment professional.
Certainly. I would say the number one thing that any individual investor or any investor in the capital markets would be best served is stay invested. Even when we go through the 2008 or the 2000 pullbacks, you oftentimes see the market come back in a major way. And if you miss out on those bull markets following a large bear market, your portfolio will experience a much it'll be much better off if you participate in those bull markets. So even when it's very, very hard to stay invested and you want to pull out and you want to go to cash or take your money out of the market, stay invested because your portfolio will be way better off long term, and you'll experience the same investment returns as the large institutions of the world.
It's great investment philosophy, and it reminds me of something I just heard recently. I know I'm running out of time, Paul, but it's a book that I'm listening to, and it's about a SEAL Team 6 and their raid on Osama bin Laden, and his statement was getting comfortable with being uncomfortable. And the concept of that is, his analogy is, we're laying in the rain, we're laying in the cold, we got not enough food, this and that, but they had to be comfortable with that. And I think the analogy to investing is amazing, because how uncomfortable is it to go through a 20% decline, but knowing if we look at point to point, if we look at any investment chart, 10, 15, 20 years later, you're significantly better off, but there's those uncomfortable times.
Certainly. That's often the time to buy, and if you can behaviorally teach yourself or have that discipline, and often why you go to a financial planner and professionals like yourself is to have that discipline to stay invested, and if you can, even invest more then, because you'll see exponential returns on the portfolio.
I love those occasional calls when the market goes down, the client calls, let's invest more. All right. Well, thanks again. Hey, how can anybody either reach you or learn more about BlackRock?
Certainly. You can go to blackrock.com is the easiest way, and talk to any of your financial advisors. We're well known at virtually any financial intermediary around the world.
Awesome. Well, thanks again, Kevin. Thanks again, Paul. And thanks for everyone who has turned in. We'll look forward to being back in the studio next week. Cheers.
Tune in next week for the latest edition of the Zandbergen Report, Tuesdays at 2 p.m. Catch up on our recent shows by visiting bartzandbergen.podbean.com. The Zandbergen Report is also available on iTunes, iHeartRadio, and Spotify. Interested in being a featured guest on our show or have a question you'd like to hear us answer? Email podcast@bartzandbergen.com. Bart A. Zandbergen, CFP, and Letitia Burbaum, AIF, are registered investment advisors with Optivest Inc. and registered representatives with Gramercy Securities Inc., member FINRA and SIPC. Investment advisory services are offered by Optivest Inc. under SEC registration.
Learn the most advanced recruiting techniques. Land the most desirable talent. Launch your company towards massive success. This is the Higher Power Radio Show with Rick Girard.
What is your company's purpose? Today we're going to help you discover your company's purpose and share ways to build purpose into your hiring process. So it's all about purpose today. Now why? Because if your model exists just to make money, you won't be relevant anymore. Guess who said that?
Sounds like something I might say.
That's actually a quote from you. Today's quote, outside of you, is when you're surrounded by people who share a passionate commitment around a common purpose, anything is possible. And that, my friends, was Howard Schultz. I'm Rick Girard, and welcome to the Higher Power Radio Show. Our purpose is to provide proven tactical solutions to solve your company's toughest hiring challenges. We share insights from top-performing entrepreneurs and industry experts like our guest today, Mr. Charles Antis. Charles is the founder and CEO of Antis Roofing and Waterproofing. He's a well-respected and widely known roofing expert, entrepreneur, humanitarian, and he began his career in professional roofing back in 1984. Since then, he's become one of the most trusted names in Southern California roofing industry, as well as an inspirational business leader championing social corporate responsibility. Charles just oozes purpose, which is what makes him the perfect expert for today's topic. Welcome to the Higher Power Radio Show today, Charles.
Thank you, Rick. I'm excited to be here.
I'm excited to have you. So today we're going to cover discovering your purpose. We're going to talk about how you get others to rally around your company's purpose, and then we're going to talk about how to hire purpose-driven people. Let's start with your origin story. I know that you discovered your purpose in a roundabout way, right?
I did. Yeah. And I think purpose is something that it's one of those topics that's not always easy to talk about. And I talk about purpose on a daily basis, it seems, with other business owners and other groups. And yet some days, where's my why? What's my why? It's like, stop asking that effing question. So some days, so I think the first thing when we talk about this is to understand that it's talking about things in a slightly newer context that's putting people first. And I think that it's a more aggressive stance than what we've seen the norm in business.
Well, yeah, because that's what the people want. Everybody wants to have or buy into a purpose. They don't really want to just go to get a paycheck. You can do that anywhere.
Yes, and there's influence there by millennials, but there's also the millennials might be the Sherpas awakening the baby boomers, my generation. And suddenly it's not about win, lose anymore. Suddenly it's about making the world a better place. What's my legacy? When I'm no longer here, did I leave the campground cleaner than when I found it, which is the old Boy Scout motto or something. That's not the motto, but you know where I'm going.
Which is cleaning up after the boomers. Yes. I said that because our engineer Paul's a boomer, and I'd like to make fun of him every chance I get.
Well, what you just said socially, I think, is true. My generation was raised to do the best we could with what we had, and we understood that if we played really hard, we could win. There'll probably be some other losers. The new generation, I think, is looking for win-wins, and I think it's very exciting, and it's a good opportunity for us to have a better social conscience.
Yeah, as much as people in our generation complain about millennials, I think they've brought in some great things. And I think really our generation's pissed off because they didn't do it first.
There's a little bit of that. That's
where the animosity comes from, right?
That's another show. I love talking about that. But I'll tell you our origin story, and I'll try not to tell a long version of it. But we discovered purpose sort of stumbling on it, and it happened like this. I started the business because I had to. I needed to provide food for my young child, and I needed work, and I didn't have enough work where I was working. And so I found that the only work I could get was doing repairs on buildings that had leaks from rain. The reason I couldn't do more is I didn't have the equipment nor the staff to install roofing, but I did develop a skill that I could sniff out and fix the leak that no one else could solve. And I would offer a management company like this, do you have a property with a leak that no one can solve? I'll do it for free. And that's how I got work. Calls were very important. And so in my home office, which was a bedroom converted, they didn't have any work. My work was putting the weather stripping up on the door so they couldn't hear the kids scream, so I could get work. And I would get like 2 calls a week, maybe 3.
Yeah, but most people, I mean, it doesn't rain that much in California either,
Right.
so that's got to be even tougher.
Yeah, so a call is like precious, like,
Yeah.
oh, so, oh my God, the phone's ringing. Hello. And so under that kind of duress, needing work and having mortgage payments of like $1,800 to make, I get a call and a lady's got leaks in every room. It's like,
ka-ching.
yeah, we're going to make money. And I drive out there the next day, and as I'm getting closer to the home, I remember noticing the home's getting smaller. It's like, oops, going the wrong way. And then I noticed graffiti and things, like it was not a nice neighborhood. Finally, I turned on the street where the home would be and just saw like dead grass in a 4-wall small home with a flat roof. And but my dad says you show up no matter what. My dad taught me a lot of things that show up in our model.
Yeah.
And that would be always do the right thing no matter what. So I knocked on the door, and then 3 things happened rapidly that kind of changed my life looking back. And that was a lady answered the door with this tired look on her face that, whoa, what's this look? And suddenly I'm hit with this big gust of mildew like I'd never smelt before, which sends me into this repulsiveness that I want to leave, and I start to back up. But as I back up, I get this pull on my finger, and contrasting my face, which is like this, and the mom's face, which is tired and anxious, this little girl's got this beaming smile, ear to ear, and she's like, she just wants to show off her house. She doesn't know that it's about ready to be taken away from her as unsafe. She pulls me in through this crowded living room into a tiny hallway, and finally she just goes into her room like Vanna White and shows me her room, because she's got this unicorn poster on the wall. But when she looks up, I look down and I see 4 mattresses with mold. Yeah, and it was one of those moments that
must have been really tough to see.
It wasn't tough, though, in the way that I see it now, like hard to see this poor girl. Now, I saw that, but it was tougher than that. It was like, oh my God, I'm in the worst possible place at the worst possible time. That's how it felt. But I've learned something that started then. I didn't know this then. Looking back, what I did is I didn't turn around and leave. I wanted to turn around and leave, but I didn't. I stayed there. I stayed with it because I was stuck. And again, my dad, that stuff, all that crud about doing the right thing, and I have this skill. I've just been telling people I'll do a leak for free, and all of a sudden there's an opportunity, but I want to run. And I sat there with that cognitive dissonance until finally the mom comes back in the room, and she has that same look. And it just at that moment, I don't know where it came from, but I stood up and I said, I'll do this roof. And it's, it's still emotional to think about it, because I think it's like I look back at that story with reverence today, because I'm glad it happened.
Yeah.
I'm glad it happened for that family because they stayed in that house. We went back with a team of volunteers. I had to get on the phone, didn't have any employees yet. We got a team of volunteers. I went to Home Depot. I purchased some crude, like some rolls of rolled roofing and goop, and we gooped that roof. It was dripping on the sides, but it didn't drip inside. They stayed. And every time I ran into those people, or the employees, or they weren't employees, but the volunteers, or the siblings, which would happen every year or so, it would be like this amazing high five. And I think that's what I see today that I couldn't see then, as I didn't know what culture was. I didn't have any employees yet. But as employees came into the company, we discovered this one thing that now is cool. But
wait, now is that where you discovered your motto or your purpose that you live under for Antis?
Well, let me tell you what that is. That you bring it up. Antis Roofing exists to keep families safe and dry. It's a beautiful thing. It's simple, but it took us 27 years to discover that slogan. I don't know why, but that is true the essence of our why. And when you call Antis Roofing and you talk to one of our 33 office employees, any one of them, and you tell them you got a roof leak, because they know why we exist. It's not making money. Now they understand that comes later, but we exist to keep families safe and dry. So there's no misunderstanding about what we do and when. And nobody does a better job of keeping families dry. We get out there, we tarp it, we do whatever we can. If we're not going to collect payment on that, keeping them dry, it doesn't end up being the thing that we worry about. And because our focus is on keeping families safe and dry, and all my people know it, all of the questions kind of trickle down, and people know they know they're not going to get yelled at for losing money on a job, because we smile at that if somebody benefits. We look for the greater good. Thanks again, Dad.
That's fantastic. All right, so you stumbled into your purpose like at that moment.
We did, and so I pulled away from the story, but we ended up. This is the other saying that it evolved eventually as we exist to keep families safe and dry. But the way it showed up first was, God, you can't let anybody have a leaky roof just because they don't have the money to pay. That was something I remembered hearing myself complain about, echoing, God dang it. I can't let anybody have a leaky roof just because they don't have the money to pay. And that would actually come up in our management meetings. Somebody would have a leaky roof. We have all these stories that are just huge in our culture, and imagine what that does. And one of the stories is a family. I don't know why sometimes it makes me emotional, but it's just a random guy that I reached out and said he had a woman that needed help with her roof. And we went out there, and I never even met her. Our team went out there, but her husband was dying. And her roof was in really bad shape. And we went out and we took care of that roof. And what it did for my employees was really cool. And I think that's what I've discovered is like, I do it. I'm a marketing guy. I tend to think outside the company, and I tend to think of the impact in terms of people. But sometimes I overlook this opportunity that occurs when this happens to your culture. I mean, this truly transforms people when they get to be involved in changing people's lives and helping people like it was their own mother. And so you can't imagine the difference. You know, one of the things I know we'll get to, but you go back to that, the stat in our industry, in the roofing industry, more than 50% of the employees will leave their place of employment this year across the board. And at Antis Roofing, we retain 93% of our employees. And the value of that is, I remember when I first started my business and somebody would come into our Vistage class and they'd say, every time you lose an employee doesn't work out, you lose $70,000. And I thought it was horse crap. In time, wow, I think that's an undersell. You know, I think it kills everything when you lose that momentum. And so that retention.
Anytime you lose somebody, it kills the momentum big time.
And multiple departments, you have all those sturdy legs holding your company together, and you have multiple legs weak, and then you see companies all out fail. And they were shocked. What's that stat? And I misquote stats bad, but like, more than half of the Fortune 500 companies from 10 years ago are out of business. Is that right? Relatively.
Yeah, something like that.
It's like,
but I think that's been more a result of technology than it has been anything else.
Sure, but okay, that's a great point. But you're absolutely right. But I feel, my expertise is on the social side of things. I feel that the explosion in what's going to happen in the social side of business is going to feel as exponential as what's happened in technology.
Agreed.
A quick story. Dallas Imbido, locally, he is the CEO and the founder of Big Rents, Cush Bottling, several on their way to billion-dollar companies.
Sure.
And we were at lunch one day, and he's a brilliant guy. He's 31, I think, and he has several companies, several more. It seems like every week he's got a new winner, and he thinks differently than I do. And so we were at lunch and we're talking. And he stopped the conversation to ask me a question, and it didn't sound serious. And he goes, Charles, wait a minute. And I've had a roofing company for 25 years. Do you guys ever make a profit? That's what his question was. And I think that was a profound moment for me, because what I heard was from one of the most brilliant young people has this Amazon mindset, or this 100% reinvestment mindset.
Sure.
And I think what's the shift that I feel right now is that investment has to start with your people. And it really
100%.
And I feel like whatever that slot is, and this is where I get bad, where I don't know the number. Let's say the corporate investment outside of payroll for employee is 10%. I don't know what it is. Say it's a 10% spend, and that's the average that all the big companies do. It feels like whatever it's been over the last 10 years, that internal number has got to go up. It's got to double. It feels like it's got to double, and that's not going to happen quickly. We're experimenting with that kind of investment into our people. And at times, for a founder, it's scary. but it feels so right because it keeps us relevant. It keeps our people showing up purposeful every day, wanting to contribute.
But here's the thing that you're doing, though. You're rivaling most tech companies. So this is something that I see in tech companies is that they build in mission and purpose, and they really live that. But a lot of the companies outside of that, they don't. They still run traditional business thinking process and how they approach growing their company. And it's all revenue and profit driven, right?
Yeah,
there's very few people, and that I see. What you're doing, I think, is amazing. It's probably an anomaly within your industry.
Well, that's a great question. It is, but it isn't.
Well, that's good to hear.
It is. It's transitioning right now, and we're part of that, which we love. I'm on the National Roofing Contractors